In this series, I've laid out a comprehensive framework for how real estate owners and investors can stay competitive and profitable in the years ahead. So far, we've covered two of the four pillars. The first one is your capital strategy. That includes treasury management, loans, and raising equity. And the second is your energy strategy. That is all about cutting costs and creating new revenue streams. Today, we're moving on to the third pillar, and that's technology integration. This one's important because if you want to succeed in real estate going forward, you need to do two things exceptionally well. That is, optimize the user experience and streamline operations. Technology is how you accomplish both. The future tenant and customer expects a lot more. The days of seamless connectivity and backup system are table stakes to say the absolute least. Technology allows you to differentiate the building in ways that actually matter. So tenants can customize their experience through the lighting, the temperature, deliveries, and even scheduling, all through apps. Amenities such as mobile access, package lockers, and EV charging creates convenience and, most importantly, stickiness. The properties that deliver this kind of tech-enabled experience lease faster, retain tenants longer, and trade at a premium in the marketplace. Across all markets, this is increasingly becoming a deciding factor for tenants. So just look at the flight to quality trends we've been experiencing the last few years across every property type. It's no coincidence that the properties in highest demand all have these features. And here's the next step, accepting Bitcoin and Lightning payments for rent. It's a market differentiator. It's going to attract innovators and tech-driven businesses. It's going to reduce fees. It's going to simplify cross-border payments, and it'll help you automatically feed your Bitcoin treasury on the back end. So that's a lever for both user experience and long-term value creation. Now, let's shift gears a little bit and start talking about the operational efficiencies. Technology integration isn't just about tenants. It's about protecting your NOI by cutting costs and streamlining the workflows. So what are the biggest cost pressures today? You have energy, maintenance, and labor. The good news is PropTech is tackling all three of them. You have IoT sensors and AI systems that optimize HVAC and lighting in real time. So this is cutting your utility costs. Predictive maintenance extends the equipment life and prevents costly downtime. Building management systems automate usage and cut out waste. And lastly, smart access and security reduce labor needs while increasing the safety of a particular location. So remember that energy alone makes up for roughly a third of your operating expenses in a commercial property. And the lighting and HVAC account for nearly 70% of that. So every penny and every kilowatt counts. That's why these systems are the focal point. Now, let's zoom out once again and remember that 62% of commercial real estate was built before 1990. Every one of those properties needs these types of upgrades if they're going to remain competitive and profitable. But here's the catch. Installing smart systems or a tenant-facing tech doesn't automatically mean higher rents. Maybe you can push them slightly in the short term, depending on your market, but it's not going to be a one-to-one return. So if your building is a 1975 vintage, it's got 47 layers of paint, no amenities, and a C-plus location, adding customizable lighting or a tenant app isn't going to transform it into some premium product. Maybe it helps with retention in the short run, but don't expect it to move the needle on rents in any meaningful way. So that's why an objective and comprehensive assessment of your portfolio is critical. You need to identify which assets are truly core, the ones that are worth reinvesting and modernizing, and the ones that aren't. But here's the harsh truth. When you look at the market through this framework, most properties were worth more yesterday than they are today. And that is only going to accelerate. So if you've owned an asset for any extended period of time, you've probably watched it double, triple, or even 4x in value, right? So congratulations. But it's now time to dispose of that asset and reallocate that capital to something more productive, more competitive, or safer. So the point is the juice has been squeezed and it's time to move on. Don't let a low basis be mistaken for long-term security. So how does this fit into the broader playbook? Let's summarize it one more time. You have Bitcoin treasuries as your capital strategy. You have dual collateralized loans as your financing mechanism. Energy efficiency is your operational defense. And now you have tech integration that is helping you win on both sides of the equation. You're able to optimize the user experience and the operational efficiencies. Together, these pillars are going to separate tomorrow's winners from everyone else because as we get into the back half of this decade and into the 2030s, higher costs, aging inventory, and capital scarcity are going to expose every weakness in the market. So tech integration is no longer optional. It is a core pillar of the comprehensive real estate strategy in a Bitcoin world. The efficient operations cut cost, a superior experience attracts tenants and customers, and Bitcoin adds liquidity, differentiation, and long-term value. It's it's not about modernization, it is survival. So, as always, I want to hear your thoughts. Drop them in the comments below or DM me. I'm also going to ask you to share this with your team, share it with your clients, share it with your property manager. I need your help spreading the word. I appreciate you stopping by, and I look forward to seeing you here next time.